Okay, good. Do you see me better? Do I look more handsome in this camera?
Yeah.
Okay, then I should keep using this computer. Okay, let's start chapter 3. I'm so sorry. I need to grab my time. So I'm sorry. I kind of lost the 10 minutes on this. I'm so sorry for that. So yeah, this picture is the marking hall. If you are from the Calgary campus, I don't know if you ever visit UofL, the main campus. So this is their marking hall. Yeah, I'm also teaching here in the marking hall prior to the COVID. So chapter 3, we are only mainly focusing on estimation, right? When we talk about accrual accounting, a lot of times we have to rely on estimation because a lot of times we cannot present the true number. Okay, there's no such thing called a true income. Okay, however, the quality of earnings can be better or worse. Okay, so the idea is we always estimate on different things. Okay, because of the uncertainties. Okay, we are facing in the real life, right? It's a lot of uncertainty events. That's where the business is operating, right? So then for accrual accounting, estimation is the central. So we want to talk about the estimation, okay? So do I have everyone in? Oh, still 4 here, okay. Okay, so, and then in terms of timing issues for accrual accounting, remember, along the timeline, right, financial reporting is only for one fiscal period. It could be, the financial reporting could be yearly, could be monthly, quarterly, right? So you are dividing the timeline in different reporting periods, right? So then, because of this is the base of accrual accounting, then there are issues about periodicity, cutoff, and the subsequent events. So we're going to talk about what do we mean by those concepts there. And then also we are going to talk about accounting change, okay? So that will be the focus of this chapter. And also it's very important, the last objective is to help us to understand how the different financial statements integrate, connect with each other, okay? And how this structure is related to accrual accounting. Okay, so you have know about this cash cycle. So for cash-based accounting, right? The idea is whenever you spend cash, your cash balance goes down, so you credit cash, right? Whenever you are collecting cash, your cash balance go up, you debit cash, right? That's basically cash-based accounting. So this is a cash cycle. Let's take a look at for the operating cycle here at the bottom of the picture. So you go from purchasing inventory, right? You pay, right? So credit cash, you pay. And then production sales, right? You probably have to pay the salary, you pay cash, you pay the delivery cost. And when you make the sales, you debit cash, you are collecting money. And you provide the service, okay? And you receive the cash. Eventually you receive the cash from customers, right? You are collecting cash. For investing cycle, this is related to the long-term asset. So you credit cash to purchase the property, and you use this property to gain benefit, right? And then you dispose the property. When you sell the property, you debit cash because you receive cash by selling this property, okay? And for the financing cycle, so you receive money from the bankers, right? From the investors, from the bankers. And then you use the money for investment, okay? And then you return the fund to the banker. So you repay the loans, right? You can see the cash cycle. So if it's only cash-based accounting, so whenever there's a cash involved, you would recognize a journal entry, okay? However, for accrual accounting, it's different. Accrual accounting is different from cash-based accounting. So because you have to recognize the information sooner, okay? because somebody is late in paying you, somebody is not paying you on time, does not mean you cannot recognize your sales, right? And so that's one reason. The other reason is because you haven't paid the other utility, does not mean you don't have to recognize the utility expenses, right? So if you pay the utility the next year for the December, you paid it in January the next year, in the financial reporting, you still have to recognize the utility expenses in the current year, right? So that's why information has to be complete, right? Information has to be complete. So that's why this is about accrual accounting. So cash accounting only recorded transactions when cash involved. Receive cash, spend cash. Accrual accounting can recognize event before or after. If you recognize event before cash transaction, it's called accrual. If you recognize event after cash flows, it's called a deferral. Okay, I'm sure you have learned this in the first intro financial accounting. So one example would be at the year end. Okay, you have to recognize your utility bills for December, even though you haven't paid for until January the next year. So you debit utility expenses, you credit account payable, right? As you can see, account payable is really the reason, the existence of account payable is really because of the accrual accounting, right here. For deferral, the example would be, if somebody pay you ahead of time, right? So you receive the cash, but you haven't delivered the service yet. If I'm a tutor, I'm really in demand, right? Many students are after me, so they decide to give me like 1 year's, they pay me for the 1 year ahead of time, right? So for me, my cash balance increased, so I had to debit cash, right? But then I haven't delivered my service yet. I haven't do the tutoring yet. So it's not a revenue. I cannot credit revenue. Instead, I'm crediting deferred revenue, right? Deferred revenue. So if you are renting a house, right, your landlord will charge you the rent on the first day of the month, right? If you don't pay, they're going to kick you out, right? So then they receive the cash, debit cash, and they credit deferred rental revenue. This revenue is not earned yet, right? This revenue is only earned, there are 3 more students here. This revenue is only earned after the 1 month is elapsed, right? So they only recognize it at the end of the month, even though they're collecting this cash at the beginning of the month, okay? So are you comfortable with this? Because this is a concept that we definitely learned about in intro financial accounting. Do you have any question on this? Okay, so you're gonna understand, right? This is the basic. What's the difference between accrue versus a cash accounting, right? What's the difference on that? We are using accrue accounting. Otherwise, you won't even see account receivable, account payable, prepaid expenses, unearned revenue, deferred revenue. Those accounts will not exist in the cash-based accounting. Yes. Arlene, do you have a question?
No, sorry about that.
Oh, no problem. Okay, let's move on. Okay, so basically, when we talk about accounting, we are hoping the accounting is free of bias, right? For the representational faithfulness, we are talking about neutrality, free of bias, right? So what is the unbiased accounting? We talked about there's no true numbers, right? There's no true numbers. So what is unbiased accounting? So this is how I see it, right? So if you hire 1,000 CPAs that are qualified, right, licensed, if they are calculating your income, okay, they each will have a different number, right? Because they use different estimate. So one person will estimate 1% bad debt. The other person will estimate 1.5. another person will estimate 2.0% bad debt, right? And the estimate will affect the bottom line number. So the idea is, if you ask 1,000 CPAs independently work on this earnings, okay, and they all have different income, okay. But when you take the average, that average is considered as an unbiased accounting number, okay. Does that make sense? Okay. So basically, this is the unbiased accounting. Okay, we're going to talk more about this, and then the IFRS concept, the true and the fair. Basically, they hope that your financial reporting is the true reflection of the underlying economic transactions, events, conditions, performance. Okay. You can see now the estimate is important. Let's do a problem together. Okay, problem 3-8. So for each of the following financial statement items, identify an estimate that is required in the measurement of item on the financial statement. Okay, so what estimate do we need to make that is related to account receivable?
That's allowance for doubtful accounts.
Very good, right? So what's the percentage for each age group? Do you use 10% for the 30 days? You use 20% for 30 to 60, right? Those percentage, very good, yeah. What else? How quickly you can collect your AR, right? How quickly you can collect your AR. Inventories, what are something related to the inventories?
FIFO?
Yeah, so the costing, inventory costing models, right? Remember FIFO, moving average, right? Those kind of fun stuff you have done, lots of calculations. Equipment, what are the estimates you have to make for equipment?
The depreciation.
Yeah, depreciation. And when you calculate depreciation, when you calculate your depreciation,
It's straight line methods.
The method, different method.
Yeah.
And the salvage value.
Salvage value, right? Yeah. And what is the
and the years?
Yeah, the years of the useful life, right? Right. Those are the things they have to estimate, right? Warranty liability.
Like how many people will claim for warranties?
Yes, very good, right? What's the percentage of the sales will ended up to be maybe lemon product? They had to be fixed, right, within the warranty term. Sales revenue.
Goods returned on sale.
A return on sales.
Yeah, sales returns, right? Sales return rate, stuff like that. Revenue from long-term contract. So if you are making a construction contract to build a building, takes more than maybe a couple of years, right?
Would unearned revenue fall under this as well?
Yeah, unearned revenue and also the progress of the billing, right? So you have to estimate the progress of the completion, right? And the percentage of the completion for each reporting period. So in that way, you can allocate the total revenue into each reporting period, right? We're gonna learn more about this in chapter 4, okay? And cost of goods sold, that will be related to inventory, right? When you calculate inventory costing, do you use FIFO? Is FIFO a better approximation to the benefit yield from, is FIFO is better reflect the inventory flow, right? I often give the example of the milk, right? You think about, when you go to grocery store, right? You are buying a milk. You are trying to get the latest milk, right? So it should be the last in, first out, right? So you may be a gentleman. You are saying, guess what? I'm going to consume the the first in, right? First in, first out. That's just the approximation, right? But if you buy things, especially like food, you want to get the fresh ones. So it should be, if the real flow should be last in, first out, right? Everyone is trying to figure out what is the expiry date, right? I'm going to get the expiry date as long as possible. But LIFO is not allowed, right? It's FIFO. But the idea is, in the situation, you have to estimate, is FIFO or moving average, which one is a better approximation to the inventory flow? Okay, so you can see right away, right? All these accounts, we have to do some estimate, right? Estimate is essential to the accrual accounting. Okay, so for example, if you have a sales transaction, okay, so it's a sales of $800, you receive $500 cash. So the cash sale is 500, credit sale is 300, right? Together, that's your sales of 800, okay? So, okay, your accrue, which is your accrue? You debit cash, you credit sales. So you debit cash for 500, you credit sales for 800. What's the other debit? What do you debit for the credit sale?
Unearned revenue.
Pardon me?
Unearned revenue.
So there is a $300 credit sales.
Sorry, that's accounts receivable, no?
Accounts receivable. So you debit accounts receivable. So that's an accrue, right? Because AR, AP, prepaid expenses, unearned revenue, deferred revenue. This is all accruals, right? So in this accruals, maybe for some people will say, the average accountant will say $200 will be collectible, right? The AR. $100 will not be collectible, okay? So then the unbiased accrual will be $200, because if you ask 1,000 accountant, they evaluate the scenario, they think on average 200 of the 300 will be collectible. So this AR is unbiased accrual, unbiased, okay? But the other 100 is considered by excessive, right? Because the manager wants to hit an earning target. The manager needs this $100 to meet the earning target, okay? If he missed the target, he won't get a big bonus, okay? So this is a bias from the manager. The manager will say, you know, I really think this client is a very good client. He will pay everything, right? So you can see about here, the unearned accrual, that is the $200 here, because the average assessment of 1,000 CPAs would agree this is be $200. The $100 is excessive accruals by the manager, because the manager has a bias, okay? So they reported $800 earnings. They should really report $700 earnings here.
So I got a question. Is this something that, like, there has to be an event that occurs that makes you think that there's going to be an unbiased accrual here and excessive accrual here? Or is it just automatically, like, accountants think or should be thinking like this?
I'm just using this as a easy example, so that it won't be confuse you, right? In the real life, it could be a large amount of transactions, right? It could be $300,000 versus $200,000, right? Maybe when the manager is using a lower by that rate, right? If the manager is using 1%, and the CPAs will think you're going to use 2%, right? The manager is trying to use lower percentage of by that to inflate the earnings.
So, but this is based all on experience, like past experience in the sense of not receiving. Yeah.
Yes. Yes.
Okay.
Okay. So what time is it? Okay. So in accrual accounting, timing is everything, right? The fact that we have accrue, this concept, is because financial reporting is in a timeline. There are divided by this reporting periods, right? So timing is everything. So, you know, it's interesting. What is going to happen if the transaction or the event is close to those, the end of the period, right? If it's just happened in the middle of the period, no problem. You recognize the transaction events. But it must be tricky when it's getting close to the end of the period, right? That's the tricky part, okay? So let's talk about it. So for business, okay, they could have different lengths of the reporting period. For most of the financial reporting for external parties would be 12 months financial fiscal period, okay? But internally, they could have quarterly period. They could have, semi-annually. It's really depending on how important, how much information is flowing in the business, right? For big business, maybe the managers has to review a monthly report, right, to make decisions, right? But for financial reporting to investors, lenders, is mostly based on 12 fiscal period, okay? And basically, it's a fiscal period of 12 months. It can start and end at any time. However, the business has to be carefully chose the year end, okay? So Dan Greenhouse is a business in Lethbridge, okay? What do you think their year end would be? Do you think they're gonna choose the year end around May 31st? Do you think they want their year end to be May 31st?
I don't think so, no.
No, why not?
No, no.
Why
It's
not?
peak season. They're just going to peak
It's
season.
busy
No.
season. Yeah, it's the
Seasonal
beginning of their
work.
season. And
Very, very good. So that's their busy season. They are really, really busy. First of all, they don't have a lot of time and energy for doing accounting things. They are trying to make sales, right? Second of all, when you have a lot of transactions near that end of the period, May 31st, you're gonna subject to a lot of errors, right? Transactions. So that's why the business will try to pick a slow season to be their the fiscal year end, okay? And the fiscal year end doesn't have to be the last day of the month. So for Canadian Tire, their year end is the Saturday closest to December 31st. So every year they have different year end, right? So for 2019, fiscal year end is December 28th, because this is a Saturday that closest to the December 31st. Why do you think they pick a Saturday?
Because it's one of their quiet days. They have less customers.
Yeah, and do you think they have to count the inventory?
Yes, they have less inventory after the end of a week.
Yeah, so basically they're gonna shut down on Saturday, right? And then they're gonna do an inventory count, right? So they would use a Saturday for that. Oops, there are more students coming. Okay. Okay, so that's the idea is about the fiscal year and the fiscal period. Okay, very good comments. Thank you. So then, okay, what is the cutoff? When we say cutoff, this concept, what is cutoff? Cutoff is a point in time at which one reporting period ends, the next period start. Okay, so in this picture, you can see this this light green kind of shaded timeline area. So they start. This is the beginning of the fiscal period. Are you able to see my cursor pointing?
Yep.
Yeah.
Okay,
Yes.
so that's the beginning, and then that's the end of the fiscal period, right? And then the next fiscal period will start. So this point is the cutoff. Okay, this point is the cutoff. So basically, it's a cutoff for recognition. Okay, so you have for this period, reporting period, you have a lot of transactions events. Okay, so this is the time for recognition. You're going to cut off at the end of the fiscal period for the recognition purpose. Okay, I mentioned about the two things, recognition and the measurement. For recognition purpose, this is your cutoff time. Okay, you recognize all the transactions events up to this point. Okay. Okay, going. Oh, here. Okay, so the period between the cutoff date and the date when the company authorizes financial statement for issuance. So when the auditor doing the work, the board of directors has to approve the final financial statement. They have to sign on that financial report, okay? So basically, from the cutoff point date to this date when the financial statement authorized, this date, all these things, period called a subsequent event period, okay? Subsequent event period. And for measurement purpose, okay, you have to consider the best information up to this date. For recognition, you recognize transactions events up to cutoff date, okay? But for measurement, for the element on the financial reporting, for the measurement purpose, you have to consider the best information, even it available during the subsequent event period, okay? We are going to do some examples to show you what do we mean by here. Okay, so let's see. Here, this question, you have seen this question, right? This spread thing, do you remember what's the answer for this question?
B.
Yeah, B.
B, 2800, right? Okay, can you tell me, this year end is December 31st. Can you tell me what is the cutoff date?
December 31st.
December
isn't it?
31st.
Yeah, 2011, right? December 31st,
Yeah.
2011.
2011.
Okay, so I need to recognize my transactions up to December 2011. So should I recognize that 3,000 bread sales? Did this sales happen before the cutoff date?
Yes, but
Yes,
then
I
there's
think
a
that, yes.
stipulation that the ABC limited within 7 days. So
Yes.
they returned it within the fiscal period.
Yeah. So you recognize the sales, right? Because the sales transaction happened before the cutoff date, right?
Yes.
Okay. Now, how to measure it? Is that should be 3,000 or 2,800?
2800.
2,800, because you have to consider information even during the subsequent event period. So in January, right, they returned 200 loaves. This information is a new information available during the subsequent event period. And to measure the sales, you have to consider this information. Okay, that's why it's 2,800. Does that make sense?
Mm-hmm.
So for recognition, you only recognize up to cutoff date, but for measurement purpose, you have to consider all the new informations during the subsequent event period. Okay, let's do some questions just to test if you understand it, okay? This question, problem 3-7-19. Below are several events that occurred after December 31st, 2021 year end, but before the completion of the audit for Fundy Capital Incorporation, all amounts are considered to be material, okay? So this event happened after December 31st, 2021, but before the signature, okay? Before the signature. So this is the happened during the subsequent events period. First one, oops, did I? Okay.